All right, let's get started. Today, we're not just looking at company reports. We're going to dissect them, consultant style. I'm going to show you exactly how top analysts cut through all the noise to find out what really makes a company tick. We're going to zero in on the core operational strength that separates the true market leaders from everyone else.
So, let me ask you a question right off the bat. If a company is profitable, does that automatically mean it's a strong business? You'd think so, right? But here's the thing. Just looking at that final net income number can be a huge mistake. It can actually hide some really serious weaknesses in how a company actually operates. And today, we're going to solve that puzzle.
You see, net income, at famous bottom line, is what's left after absolutely everything, including interest payments on debt and all the taxes gets taken out. But here's the crucial insight. A company's debt structure and its tax strategy are choices that are separate from its main business. To really understand if a company's business model works, you have to isolate its operational engine, the pure profit it makes from just doing its thing day in and day out. You know, judging a business on net income alone is kind of like judging a car by its paint job. We need to look under the hood.
So here's our game plan. First, we'll dig into why that bottom line just isn't enough. Then, I'll introduce you to EBIT, our tool for getting a much clearer picture. We'll see why it's a favorite for analysts, and then we'll put it to work with some really powerful ratios. And importantly, we'll talk about its limitations, before we wrap it all up with a new way to look at performance.
Okay, first up, let's move beyond that bottom line. It's time to break down exactly what that net income number might be hiding from you.
You know, financial statements aren't always as clear as they seem. They can get cluttered with one-time events or different accounting choices that can really muddy the waters. For example, a company could sell off a huge factory. That would cause a massive spike in net income, but it could be masking the fact that their actual sales are tanking. On the flip side, you could have a super efficient company that shows low net income just because it's carrying a ton of debt from past investments. Our job is to cut through all that noise and find the real signal.
And that brings us to the solution. We have to isolate the operational profit. The tool we use for this is EBIT, and you can really think of it like a financial scalpel. It lets us surgically remove all the distortions from financing and taxes so we can see the true health of the business underneath. So what is EBIT exactly? Well, the name is literally the formula. It's the earnings before you subtract interest and taxes. It measures the profit a company makes purely from its core business operations. So for a coffee shop, it's the profit from selling coffee and pastries, and that's it. It answers one simple question. Is the fundamental business profitable? And by the way, on most income statements, you'll see this listed as operating income or operating profit. They're the same thing.
And this is the central idea, which Olemi Dada sums up perfectly here. When you strip out the financing and tax structures, you get this unfiltered view of a company's core profitability. It really is the cleanest way to see if the business model itself is actually working.
Okay, so how do we calculate it? Well, using the top-down method, we start right at the top with total revenue. From there, we subtract the cost of goods sold, or COGS. Just think of that as the direct cost to make the product. Then we subtract operating expenses, or OPEX, which is basically the cost to run the business, things like marketing and salaries. And that number you're left with, that's EBIT.
Let's make this real with a quick case study. A company called Bright Tech Solutions. Let's say they brought in $1 million in revenue from their smart home devices. Now, the direct cost to actually make those devices, their COGS, was $600,000. And the cost to run the business itself, marketing, salaries, rent, all that, their operating expenses came to $200,000.
So pretty simple math, right? We take that $1 million in revenue, subtract the $600,000 in COGS, and subtract another $200,000 in operating expenses, and that leaves us with $200,000. That is Bright Tech's EBIT. It's the clean operational profit from their core business, and it has nothing to do with their debt or their tax situation. This number shows us the true health of their business engine.
Okay, so now we know what EBIT is and how to calculate it. But let's get into why it's such a critical power tool for both investors and the managers inside a company.
EBIT is incredibly versatile. Its biggest strength is that it lets you make true apples-to-apples comparisons. Just imagine two retail companies. One is funded by a mountain of debt, the other is all equity. Their net incomes are going to look totally different. But EBIT ignores all that and tells you which company is just fundamentally better at managing its stores and selling stuff. Internally, managers use it to spot trouble. If your revenue is flat but EBIT is going down, you know your operating costs are spinning out of control.
It's also absolutely crucial for lenders who are looking at risk and for companies thinking about buying another business.
Now for the really practical part. Let's put EBIT to work. A number on its own is pretty useless without context, so let's see how analysts turn it into real, actionable insights using a couple of key ratios. The first, and I'd argue most important ratio, is the EBIT margin. All you do is divide EBIT by revenue, and what you get is a picture of the company's true operational efficiency. It answers a simple question. For every single dollar of sales, how many cents does the company actually keep as pure operating profit? A higher margin is a fantastic sign of great cost control, strong pricing power, or maybe both.
And this chart just makes it crystal clear. Company A is chugging along below the industry average, while Company B is crushing it. This tells an analyst that, forget their net income for a second, Company B is simply the more efficient operator. An investor would probably favor Company B, and a consultant would walk into Company A and tell them they need to figure out what's going on with their costs or their pricing like yesterday. Next up, we have the interest coverage ratio. This one is all about financial risk. You just divide EBIT by the company's interest expense, and it tells you how many times over the company can pay its interest bill using only its operating profit. Lenders watch this ratio like a hawk. If it dips below 1.5, that is a major red flag. It suggests the company is getting dangerously close to not being able to pay its debts. Anything over 3, though, generally means they have a healthy safety cushion.
Now, as powerful as EB is, it is not perfect. It's not a silver bullet. To use it like a pro, you have to understand its blind spots. Any great analyst knows the limitations of their tools just as well as their strengths. A question I get all the time is what's the difference between EBIT and its very close cousin, EBITDA? It's a common point of confusion, and understanding the distinction is absolutely key to knowing which metric to use in which situation, because they tell slightly different stories.
So EBITDA adds 2 things back into the calculation: depreciation and amortization. You can think of these as non-cash paper expenses that just represent the value of assets wearing down over time, like a factory getting older or a patent losing its value. By adding them back, EBITDA gives you a rough proxy for a company's operational cash flow. This is super important in capital-intensive industries like manufacturing or airlines, where those D&A charges are huge. Because of this, EBIT is often seen as a more conservative and sometimes more realistic measure of a company's actual profitability.
And that brings us to the ultimate reality check, which is captured perfectly in this quote. While EBIT is great for showing profitability, at the end of the day, cash is king. Real financial strength comes from cash flow, the actual money moving in and out of the business that you need to pay bills, invest in growth, and just survive. There's a saying in finance, profit is an opinion, but cash is a fact.
So to quickly sum up the limitations, EBIT completely ignores very real cash obligations like taxes and interest payments. It also doesn't tell you how much cash your company needs to spend on new equipment just to keep the lights on. And, like any accounting metric, it can be influenced by different accounting methods. So just remember, EBIT is an absolutely essential piece of the puzzle, but it is never the entire picture.
All right, let's bring this all home and lock in our key takeaway. It's time to start using EBIT as a true performance lens.
So if you remember one thing, make it this. EBIT is the tool that lets you cut through all the distracting noise of a company's financing choices and its tax strategies. It strips everything away and brings the analysis down to the most fundamental question there is. How good is this company at its core business? It gives you a clean, unobstructed view of the business engine itself. So I'll leave you with a challenge. Go pick a well-known company, one that you follow. Find its financial reports and track its EBIT and its EBIT margin over the last 5 years. Completely ignore the net income headlines for a minute. What new story do those numbers tell you about its operational health? How does it change your perspective on that business? That is the power of this true performance lens, and now you know how to use it.